All right, everyone, welcome back to another weekly roundup edition of On the Margin. Today, I am joined by my colleague, Jack Farley. Jack, welcome to the show.
Great to be here. Thanks, Mike.
Awesome. We miss you, Mark. But Jack, you and I have a really good show lined up for this week and a bunch of really interesting topics to talk about.
We do. And what, Mike, before we start out, can I just say I've kind of am changing kind of my outlook and what I cover. So, I'm on my show Forward Guidance. People know me as interviewing like macroeconomic people, finance.
Mm.
I'm totally changing it all. I'm rebranding myself as an AI expert. So can you actually introduce me as an AI expert, because I'm just getting really into it, and sky's the limit, man.
I think that makes a lot of sense. If you're listening to the VCs, the one takeaway is that you should pivot to AI. So I think that's a really smart move, Jack.
Yep.
All right, Jack Farley, AI expert. This is going to be a good show. I actually want to start this conversation this week in the realm of Bitcoin because it's actually been a very big week in terms of institutional movement in Bitcoin, which is a sentence that I haven't said probably in the last 18 months. So this week has been characterized by a slew of filings for a spot Bitcoin ETF. So the first one that happened at the tail end of last week was from BlackRock. And that really surprised a lot of folks. BlackRock is obviously one of the largest, I think it is the largest asset manager in the world at $9 trillion of AUM. Their record of ETF approvals by the SEC is 575 to 1. I like those odds, Jack. I don't know about you. If I was a betting man, I would definitely like that. And post BlackRock, we've sort of seen a slew of new spot ETF filings, notably from Invesco, which is one of the largest ETF issuers in the world at $1.4 trillion of AUM. Wisdom Tree, which has filed ETF applications in the past at $90.7 billion of AUM. And then Bitwise, which is sort of the crypto native index offerer. Really, really love the folks over at Bitwise. So the just again, the sort of background on this is that the SEC has rejected multiple spot ETF applications to date. We have gotten futures applications, but not spot applications, because of concerns from the SEC that issuers could not put in place adequate surveillance sharing, and they could not provide protection against market manipulation. So it's been a big week for the orange coin. We'll be fine. So here I'm gonna share some slides here to walk you through, because there's been significant change in the price action of Bitcoin here. And one chart that I want to draw people's attention to is something called Bitcoin dominance. So Bitcoin dominance is a measure of the percentage of overall crypto market cap that Bitcoin represents. So what we're looking at is a chart going all the way to pre-2015 here. And there are sort of two things to know about Bitcoin dominance. There is a secular trend to pick up on in terms of Bitcoin dominance, and then there's more of a cyclical trend. So the overall trend, the secular long-term trend of Bitcoin dominance, is to go down. So obviously for a period of time, Bitcoin is one of the oldest and still the largest by market cap cryptocurrencies out there. So especially pre 2017, 2018, you remember that little cycle. It was really the only thing that you could buy, sell, hold, trade. Obviously now there's a whole slew of different crypto assets. So over time, I think the trend is you should expect for market cap, the relative percent of Bitcoin that makes up crypto's market cap, to trend down. So back in 2016, 2017, it was floating between 90 and 95%. Today it's at about 51%, but that's up quite a bit. The other thing to understand about Bitcoin dominance as an indicator is there's something cyclical that happens. So in general, at the very peak of these sort of mini cycles that crypto goes on, that is when Bitcoin dominance is at its lowest. And then when the bear market sort of resumes, the Bitcoin dominance makes a comeback. The other thing to understand as well, that might look a little funny looking at this chart, is that Bitcoin dominance was going up through 2020 to 2021. And you might say, Jack, that, hold on a second, Mike, you just said that Bitcoin dominance goes down during bull markets. That is true, but it goes down during the extreme peak frothiness of bull markets. What it does is, after there's been a gigantic sort of leverage washout bear market, Bitcoin tends to be the first asset that gets a bid. The price appreciation in Bitcoin tends to get bid up as market makers, they want to take more risk outside of just Bitcoin. Some of those flows then move into altcoins. That creates the speculative mania blow off top, and then we sort of wash, rinse, repeat. So the idea here being, we start to see Bitcoin dominance trend up since about the beginning of 2023. which tends to be indicative that the worst is behind us and we're recovering. And sort of the news about Bitcoin ETFs filings from BlackRock and Invesco and WisdomTree and Bitwise, that all sorts to point to the same thing.
Right. The way I think about it is kind of like Apple, the stock, computer company, if you've heard of it. In March of 2020, or in April of 2020, let's say, leading the charge out from the huge panic that was March 2020 were the mega cap tech stocks, Apple, Facebook, as it was then known, Google.
Mm,
And those really led the charge for stocks higher. The smaller cap names, the riskier names, higher beta names, some of them were a little shaky on their legs, even though the bull market had already started. It wasn't until the market had asserted itself and investors felt a little more confident in the end of 2020. Oh, maybe the recession is over, and actually there's trillions of dollars floating around, and people are interested in buying stocks, and they'll really buy anything. That is when the electric vehicle companies that were started by people with a checkered past, let's say, those started rallying really hard. So it's those higher beta names that lead in the tail end of the bear market, and that's when we saw sort of the SPAC boom in 2021. When the Cathie Wood ETF ARKK owned some of those very high beta names that led the way in the tail end of the bull market, and they're the last ones to surge, but they surge a ton, and they're the
mm.
first ones to crash, and that's when a bull market turns into a bear market. The stalwarts, the Apple, the Microsoft, they are pretty steady, and it's not until they start going down that you're actually in sort of the middle phase of the bear market. And then when they stop going down, that's when we're in a new bull market. And that's exactly what we saw in stocks. And I think it sounds like it works exactly the same way in crypto. I'm going to take a guess that uh, you know during the end of a bear market, when it gets really ugly, Bitcoin outperforms all of these more speculative currencies and crypto assets, and but then it leads the way into a new bull market. So I don't know. I mean, I really haven't been following this at all, but it seems like a pretty big deal. I mean, how much is Bitcoin up? How much are we up?
Yeah, so let's just take a look at the price action over the course of the last week and exactly that relationship that you described as sort of the stalwart blue chips sort of leading the way. It's the same thing in crypto as well, with Bitcoin sort of representing or being a substitute for Apple here. I think if you look at this chart just over the last 5 days,
Twenty
it's sort
percent,
of yeah, it sort of
15%.
illustrates exactly what I'm talking about here. So we've got the price of Bitcoin, Ethereum, and Solana. So these are three of the largest by market cap and sort of the stalwart layer ones in terms of crypto. And you can kind of see exactly what I just described. So the blue line here, which is Bitcoin, you can clearly see it leading the charge and it's outperforming Ethereum and Solana. That is that is the sign of in crypto historically, that's been the sign of a healthy rally as opposed to less healthy rallies when you have not necessarily Ethereum, but some of the less proven and tested layer ones or sort of the apps or sort of risky projects leading the way. That's indicative that people are being it's an extremely risk on market, and more often than not, that's being driven by leverage. So the fact that we're looking at a very healthy market response to the news of the spot filing for from BlackRock and all these other issuers, I would just say that's a very good thing. You kind of want to own Bitcoin at the beginnings and the ends of bull markets, so not necessarily so much in the middle. Um, the other context here is that, and you've seen this in the price of Coinbase and these very public enforcement actions that the SEC is taking against Binance US, CZ himself, BAM Trading, and then Coinbase, of course, is that there's sort of been a wall of worry forming in terms of the regulatory climate for crypto in the United States. The only crypto at this point that has not ever been accused of being a security by the SEC is Bitcoin itself. So, this the what the market seems to be interpreting from the filing of BlackRock's spot ETF is not necessarily that this is guaranteed, but that BlackRock is very serious. They don't
Yeah.
fuff around with this sort of thing, and if they're filing for a spot Bitcoin ETF, it means they're pretty sure internally that they're going to get that application. So I think this is what you're sort of starting to see is there was an idiosyncratic break to the downside in terms of crypto overall. It's just been an absolutely brutal market for the last 12 months, even much worse than what's going on in the Nasdaq or the S&P. And I think you're starting to just see a little bit of mean reversion here.
Right. Yeah. BlackRock, they tend to not shoot blanks. And even though to me, the difference between a futures ETF and a spot ETF, even though my personal preference is it's going to trade the exact same way, who cares? A lot of people care about it, and the market moves on what a lot of people care about. Yeah, so let's talk about the regulatory fight. So there's first
Just
Coinbase. Yeah, go ahead.
just one quick note there, Jack. Just as listeners of the show may be aware, there's sort of a mechanical difference in between a futures and a spot ETF. So the ProShares futures Bitcoin ETF that's been approved, there are roll costs, and these are the same
Mm,
roll costs that you might see in the
good
U.S.
point.
oil sort of
Yeah,
ETF. And basically, when you have a future, there's sort of an expiry there, and what these ETF issuers have to do is roll that position, sort of constantly forward, and there are costs for doing that. The contracts need to be repriced. So those
yeah.
sort of costs are sort of eaten away at your position over time to the point where it's actually very difficult to hold and own a commodity based ETF. So that would just be the difference that I would highlight.
You first, I stand corrected. You are completely right. I'm going to take a guess that Bitcoin is typically in contango, which means every time you want to roll it forward, you got to pay just a little bit, just and you get chiseled away. And the ultimate example of this is look up UVXY, which owns short-term VIX futures, not an actual commodity. It's kind of more of an
Yeah.
idea. But it's super upward sloping, and it's existed since probably like 2010 or something, and it's literally down 99.99999%, basically 100%. You lost all your money.
Yeah.
So I completely agree, and yeah, that's a great point. Oh, but okay, so on the crypto regulation field, okay, so the Binance news came out at the same week as the Coinbase news,
Hmm.
and they're both troublesome and alarming. But I feel like people group them together, and they're really not. Because Binance is that news is really really bad, and Coinbase is just kind of the SEC is asserting itself. But I mean, I heard on another podcast someone who's a giant crypto bear, say actually that they thought it might actually could be good for Coinbase and crypto because once the fee, it's $50 million, $500 million, it's a bitter pill. But once the Coinbase has to pay a fine, it kind of gets legitimized. Whereas Binance is, I mean, a totally different story.
Yeah, I would say it sort of is. They've been unfairly lumped together just because of the timing, but I agree they're very different sort of allegations. So in terms of Coinbase, I don't have it in front of me, but the two big things basically are that the allegations that Coinbase has been operating as unregistered brokerage, and then there's the implication that the staking program that Coinbase runs constitutes a securities offering. On the Binance side of things, it's definitely much more serious. Everything from commingling of customer accounts, similar to an FTX type situation, to Cheng CZ, the head of Binance, owning, sort of there are market makers that are controlled by CZ that trade against customers, all sorts of different types of things. So definitely one is much more serious than the other, and it's sort of reflective of the different strategies that both Coinbase and Binance have taken. And Binance is sort of the cowboy, and
Mhm.
they are basically don't abide by almost any regulation, and they're they're the way they've domiciled themselves on a global basis is definitely tricky and a little bit new and probably a bit riskier. It allows them to take more risk in terms of their product strategy. So there's very little coins or tokens that they don't list, which is very good for volume. They also have an enormous amount of volumes that comes from their derivatives offerings. Whereas Coinbase has tried to do everything blue chip and by the book and be based out of the US. The advantage there being, as this regulation has gotten written, I think Coinbase thought that they were going to have a seat at the table. So far, that has proven to not be as good of a strategy. But the silver linings here is that, if we get a good outcome from the perspective of crypto and frankly, investor protections as well, then Coinbase might wind up with a relatively minor fine. They end up getting legitimized, where is the whatever ends up happening with Binance is more hobbling. And sort of the precedent that exists in crypto here is you could look at an exchange called BitMEX. And at one point they were extremely dominant in the perps market, which is a type of derivative. They got, I think their founder Arthur Hayes was actually, there were three founders and they actually had criminal charges pressed and it ended up being all right, but the exchange never really recovered in terms of volume.
I think Arthur Hayes actually has enjoyed a few of my interviews with Felix Ulof. So
Nice.
I can
Yeah.
say that's a nice thing about him.
He writes some great macro posts. I
He
love
does.
his stuff. A little
Yeah.
long, but I definitely like his stuff. They're great.
Yeah. All right. Should we move on to why have things been rallying? Mike, you interview people, I interview people, and as you and I know, everyone is always right. People make a prediction about we're headed for a recession or inflation's coming way down. depression, Fed could never raise rates, every prediction is right,
Hmm.
But in all seriousness, it's a lot easier to diagnose maybe and look back with the benefit of hindsight. Why has the stock market performed so well, or performed so badly, or inflation has fallen down, rather than reverse engineer it and use reasons to make predictions about a future that is inherently unknowable. So I think a question I'd like to explore is why have we been rallying so hard? I mean, it's not just crypto. The Nasdaq's up, I think over 30% this year. S&P up, well over 10% this year, and things are really on a tear. And I think it's important to explore why. So I just did an interview with Michael Howell, so I've got a few
Yeah.
thoughts I can share on that.
Yeah, please do. He's great in terms of the liquidity picture, and I got to give him credit. I think he was on forward guidance or maybe forward marginal guidance or at some point back in October calling for a bull market. And he's
Yeah.
been, at least through today. So we're talking at the end of June. He's been largely right about that.
Yes, and I especially value that because when people talk about liquidity, it's so often coincident. Like if we're right now, everything has gone up, people say, "Oh, liquidity is rampant," and if things have gone down, they say, "Why have things gone down?" Because there's no liquidity. It's kind of like a self fulfilling prophecy. But Michael's track record, over the past 2 years, which is when I started following him, has been exemplary, predicting the bear market and predicting the sort of new bull market. Oh, I can't believe I said it. Or the vigorous rally we've had over the past eight or so months. Okay,
Mm.
so first of all, the debt ceiling caused the U.S. Treasury to not issue Treasury bills, and that prevented money that would normally not be in the financial system because it had to fund the US Treasury, just could stay in the financial system. So that enhanced liquidity. Second, the Fed's rolling off its balance sheet via quantitative tightening, the opposite of quantitative easing. That was very slow because mortgage backed securities prepaid. It's a little wonky, or excuse me, they're not prepaying. So the duration of these mortgage backed securities is extending. So the Fed's balance sheet isn't going down by as much as some had anticipated. Let's see. Another money is coming out of the Fed's reverse repo facility, which is kind of an inert deposit of money, where once it's in there, it's kind of locked up. And then, so that's, I think, those four reasons. The fifth is that bond volatility itself has fallen, and stock market volatility has fallen. It's just a kind of self fulfilling prophecy within markets. When things go up and you just grind higher, implied realized volatility is lower, so implied volatility in the future is lower, and that gives market participants the ability to take on larger positions. And I'd say the sixth reason, which is probably the biggest reason of all, is that inflation has actually fallen.
Mm.
Core inflation has been very sticky, but actual inflation has fallen. And actually, there's a chart. If you can go to slide, what
Yeah, I
is it?
sure can. I think it's the slide
Slide
here.
4, the 5-year CAPE and 5-year CPI.
Yeah.
Markets really like 2% inflation. There's something about 2% inflation that markets love. On the x-axis, we've got the average for the 5-year CPI, and it's kind of like a upward facing parabola. And on the y-axis, we've got the 5-year average of CAPE, so cyclically adjusted PE ratios for stocks, price to earnings valuation multiples for stocks. And when inflation is super high, stocks have a low valuation. When inflation is super low or we have deflation, stocks are also poorly valued, probably because we're in a recession or a deep recession, maybe even a depression. But there's something about that, 1%, 2%, 3% that stocks just love. And that's when you can get price to earnings multiples of 30. And inflation has been falling quite sharply. And so much of that has been oil and natural gas, just energy prices declining. And that can't necessarily last forever. Plus, there are base effects if you calculate year over year. But declining inflation is very good for risk assets and very good for the economy because people say, "Oh my God, I was getting blasted by this $7 gas, and now it only costs $3.50," and so they'll spend more, even if a year ago it actually still cost $3.50. It's a rate of change type thing. So that I think I threw out like 6 reasons why. So at least a few of them I think should reasonably be accurate to cover why the economy has been resilient and risk assets have done well. And that's another thing. The economy has been resilient. Like recession calls that I've uh, been witnessing and been present to for over the past year, it hasn't happened. You could make the case two things. Number one, the recession is just going to be moved out. So now it could be into 2024 recession, which is crazy because people were talking about 2022. Joseph Wang, of course, the Fed guy, he said recession in 2024, and he's never thought about recession. So even Joseph is getting a little worried now. And
Mm.
that's the sort of bear case. The second case is the optimistic case is that the recession already happened last year in 2022, and that blue skies ahead. That's kind of Michael Howell's view.
Hey everyone, we'll get back to the show in a minute, but just wanted to let you know that we've got our permissionless conference coming up. This is the one that we do with Bankless. It is the biggest and best conference in DeFi. It's going to be in Austin, Texas this year, September 11th through the 13th. If you've been in crypto for a while, you know that bear market conferences are the best conferences because those are the ones that all the alpha's at. This year, we've got a phenomenal lineup of speakers, and the topics that we're covering are insane. We're going to be talking about ZK Tech, roll-ups, account abstraction, MEV, app change, the whole suite of stuff. I cannot wait myself. So, because you're a listener of this podcast, you're also going to get a discount. Type in PODS20 and you're going to get 20% off your ticket. Click the link at the bottom of this episode and go get it now because prices go up every 2 weeks. Yeah, I have a lot of questions there. So one thing that I'd be curious to sort of get your take on is I've sort of had this, and this came up as well in my recording this week with George Goncalves, who is the head of macro strategy at MUFG. So
I heard that.
one explanation, right? There's the liquidity, and we know at this point, right, that liquidity sort of drives all. So I basically listen to everything that I can get my hands on that Michael produces and records. I know your episode just dropped this morning, so I haven't had the chance to listen to it yet. But I'm a big believer in that framework for looking at, especially short to midterm price action, the sort of liquidity picture. The other, we also know, Jack, that monetary policy acts in long and variable lags. And the time frame that I'd always heard was about 18 months, right? And that, we started hiking back in March of 2022. It's been about 15 months. And people are sort of sitting here scratching their head and wondering, well, where is this recession that was supposed to happen? We know, right, that it takes some period of time, but why hasn't it come yet? And, this sort of Occam's razor, simplest explanation that at least I can think of is last year was, I think, the worst year. Jim Bianco has these charts since
Mm-hmm.
the 1800s or something like that in terms of the 60-40 portfolio. Weren't we always going to get some amount of mean reversion, right? Like, weren't we always going to catch a little bit of a bounce off of the bottom there? Now, what's going on from here? I feel like we are still due. I'm in the Jack Farley camp that I don't think there's any such thing as a free lunch, right? When you withdraw liquidity and the M2 money supply and the Fed basically tells everyone that they want a recession, I think we're probably going to get a recession. Maybe it just hasn't happened as fast as we all might think. What would you say to that analysis?
I mean, if you're in the Jack Farley camp, how can I disagree with you? I think you're right. And here's where I think Michael's description, diagnosis of why the market has rallied, why there has been liquidity is very apt and accurate.
Yeah.
And but it's been mechanical. It's been all of these facilities that are way over my head and super complicated and way over the head of many people who whose job it is to understand this stuff. Frankly, it's just so complicated. It's just the way it happened. I don't think that the Federal Reserve is intentionally targeting a certain level of we'll tell the public we're doing quantitative tightening, but actually we're doing shadow quantitative easing. Michael kind of thinks that they are, Michael Howell, and he thinks that they're targeting a certain level of bank reserves, just over $3 trillion, that the level of bank reserves in the US actually dipped below it during the UK gilt crisis, and that since then the Fed has had its hand on the till, and I'm sure they've been observing it and tracking it. But these facilities that the Fed has set up, like the reverse repo facility, uh, or the discount window, which was used a lot, and the new BTFP program used a lot in March, April, and June, May of this year for Silicon Valley. It's up to the banks to take up how much lending they want. If JP Morgan wanted to borrow $100 billion tomorrow via the discount window, it could. It just wouldn't make sense because they have an excess of cash, and their cost of funding is close to zero, and that discount window funding would cost 5%. So, when people put money in or out of the reverse repo facility, it's not. I don't think it's really the Federal Reserve quote doing it. It's just the facility is just there, and the debt ceiling, falling bond volatility, so many factors I think the Fed ultimately has no control over, maybe with the exception of bond volatility because does control rates. But um, I think that for liquidity to continue to increase, the Federal Reserve will have to do something overt. It will have to say, "Oh, we're actually going to stop quantitative tightening," or "Actually, we're going to start resuming quantitative easing." I'm with Daniel DiMartino Booth that that is just not on the table anytime soon, unless things get really, really, really bad. And I also think this is related to the topic of, is the Fed done hiking? I think Jay Powell made it quite clear that the answer is no. And now the market is pricing in for the Fed meeting in July close to an 80% chance that they do hike. So the upper range will be 5.5%. The Bank of England today just raised interest rates by 50 basis points, 0.5%. And the market is pricing that like sterling overnight rates get to above 6%. I think by the end of the year. So
Mm.
higher for longer. And yeah, I don't think that is good for risk assets, and I think liquidity probably will decline. Now, you had the world's foremost liquidity expert disagrees with me, so it's like, who are you going to believe, me or the expert? But that's just the way I'm thinking about it.
You know what? I think I was just looking here at my bookshelf, and there's this book called The Three Body Problem that I really
Mhm.
love. And what it reminds me of, Jack, is the idea behind the three body problem is actually a sort of a spatial physics problem that was described a little while ago by some famous mathematician, where, if you have two bodies of with a known mass and sort of gravitational pull, you can understand, based on a given period of time, based on how much they weigh and their acceleration, et cetera, where those two bodies are going to be relative to each other after a period of time. If you introduce a third body, you would think, if you know all of the factors, again, of how much they weigh and the acceleration, et cetera, you should be able to, after those three bodies interact with each other over a period of time, know exactly where they all are relative to each other. Turns out you cannot do that. It's actually very, very difficult. And when I think about liquidity, there are three things that I think about. There's the reverse repo facility, there's the Fed balance sheet, and then there's the TGA. And somehow these things together, I feel like you should just be able to tell what the liquidity picture is going to be. These are known relationships relative to one another. And yet, for some reason, to me, they produce this weird third body problem sort of outcome when it comes to liquidity, where it's just very difficult to measure at any given point what liquidity is going to do. And maybe ultimately, liquidity is sort of what it needs to be based on political needs. And I know I've told you this before. My favorite episode that you've done of all the great episodes that you've recorded over the last 6 months was the interview with Sir Paul Tucker. And
Oh,
Sir Paul Tucker also went on a Grant Williams show, which I highly recommend people listen to. But he sort of described this political brinksmanship that sometimes happens in between monetary policymakers and fiscal policymakers, where, let's say, there's some sort of big event, like a COVID style event that happens and monetary and fiscal policymakers meet. And they say, hey, we've got to do something about this. It will be better if we work in tandem as opposed to working separately. Okay, everyone meets in a room. They say, hey, I'm going to do this. Maybe I'm going to cut rates. And, the government, the fiscal policy side of the aisle, they say, I'm going to spend money. We're going to increase deficit spending for a little bit. Okay. Then everyone leaves the room. Then there's a little bit of a game theory that goes on where, you as the monetary policymaker, you're like, I want to hold up my end of the bargain here. Your political advisors tell you should not do that. You absolutely shouldn't. XYZ risks, you're not taking into account XYZ, and you say, okay, well, what if I didn't fulfill my side of the argument? What would end up happening? The other guy who is also in this agreement would have to do more, right?
mm.
Because if you don't fulfill your side of the bargain, then fiscal or monetary is going to have to do much more to get to the same result, and you're going to be totally fine. And I feel like that's a pretty good lens to look at. Like, you and I get on here and we talk about the Fed very often, right? What's fiscal doing?
Yeah.
What is fiscal doing? Because we're talking about Jerome Powell channeling his inner Volcker, getting up there, raising rates to, by the way, a historically normal range for interest rates, and fiscal still running $2 trillion a year deficits. So that, I feel like, is an underdiscussed part of what's going on, because that also, I think, contributes to liquidity, is how much the government wants to spend.
Completely agree with you. I think fiscal matters so much. When the government borrows money, it's a government deficit, and a government deficit is the private surplus. Whatever the government, is debt. That's what the private sector is getting kind of
Mm.
for free, and I'm putting that in quotes. Uh, Ultimately, I would think that demand the if the U.S. government borrows so much money, the supply would cause interest rates to rise, bond yields to rise because it would have demand. I think that's the model for every single country that's not doesn't have the global reserve currency, which the U.S. dollar does have, and then the Federal Reserve can step in to buy that debt as well. I think China, it's not that they haven't been dumping treasuries, but their uh, treasury holdings have been somewhat declining. I think over the past 10 years, and that happened while the Fed was doing a huge amount of quantitative easing. So, I think if the Federal Reserve does not come to the rescue and buy these treasuries, and the economy is still very strong, so growth and inflation are still high, and particularly inflation is high, I can see bond yields rising more, and that would increase the fiscal expense. Now, the demand for treasuries is just so massive that of course there will be a bid, and it could be even lower. I mean, people who've been predicting high treasury yields since 2008 great financial crisis. The prediction has not worked at all up until like about a year ago. Um, but yeah, fiscal has been huge, no doubt.
Yeah, yeah, I agree. Speaking of maybe less on the fiscal side, but more of Jerome. Jerome's had a couple of, or Chair Powell, I should say, has had a couple of Senate meetings this
First
week.
name basis. Yeah.
Sorry, that was very, very familiar. I apologize,
No,
Chair Powell, if you're listening here. But I know you actually tuned into some of those, so I'd love to sort of get your high level take on what those hearings have yielded.
I mean, he's made it pretty clear at least one more hike and maybe slash probably two. He's talked a lot about forthcoming bank regulations that are going to be coming, but the proposal is there's not even a final draft of the proposal yet that would maybe increase capital requirements for large banks. And a lot of Congress people are asking, "What about the small banks?" He said, "Don't worry about it," but they still are worried about it. Um, but yeah, I mean, it's funny. The last time he was in Congress was a day or two before, I think literally one day before Silicon Valley Bank failed. So the timing is strange.
Yeah. No, not exactly great. I mean, I think that's what we've been talking about here. I mean, the Fed wants to be data dependent. I think the pause was actually a pretty savvy tactical move to give themselves a little bit more time. It seems like although core PCE has been particularly sticky and has not trended down the amount that they've wanted, they've given themselves a couple of months of reprieve to hope that it continues to trend down, and then they can be data dependent and you know and not risk breaking the system with more aggressive hikes. So, yeah, I think about one more hike sounds right.
Yeah, I mean, I have been doing some work on the banks, and if you look at the number of banks, I think the majority of banks in the United States are not having a good time with high interest rates, to put it lightly. And if the Fed raises from 0% to 3%, and they do so over 5 years, let's say, at the beginning when the Fed funds rates at 0%, the banks are paying 0% for their deposits, and then they raise 25 basis points. They can keep their rates at zero. Then they 25. No one cares. No one's who is Jay Powell? They're focusing on stuff. But when the Fed raises by 500 basis points in a year, then people are saying, "Hey, why is this bank still paying me 0%?" So that's why all these regional banks are paying 3% for their deposits. Their total cost of funds, their spot cost of deposits could be even higher in some cases. And they made loans at 4%, and so their net interest margins are very very narrow. And that's just their gross profit. And then there's like they've got to pay for their people, they've got to pay for all the costs, also insurance, all sorts of things. So uh, if the banks, I think, were not publicly traded, they could just handle a few quarters of losses and it would be fine. But I think you have this phenomenon where the bank is going to lose money, uh, even with credit loans not going bad, but it's net interest margin. It's just the math doesn't really work. And then so the stock sells off, and then depositors think that there's smell smoke, so they think there's fire, and then they leave, and then the stock falls further, and you get this kind of doom cycle. I actually think that the large banks are in a quite strong position. I haven't looked into this new capital rule, and I think that banks are selling off today on the Thursday of June 22nd, perhaps on fears of this, although you never know the reason why anything moves. but they are in a quite strong place, and they could lend much more if they wanted to. I also, I don't want to say no, but I have a strong inclination that regional banks are pulling back lending quite strongly. And I don't know whether large banks will be there to fill in the gap. During the great financial crisis, large banks withdrew lending so much, and regional banks actually, I think, lent more, and they tried to fill in the gap, but they couldn't, and that's why lending really contracted, and that lasted for a long time. Um, but yeah, regional banks are pulling back. And I did an interview with Randy Woodward and John Tuhig. John Tuhig trades loans, and he said it's just really tough. Talk about liquidity. Liquidity in the loan market is not there. Liquidity in the housing market is not there. If you want to buy or sell a house, liquidity. So that's one thing I talk about with Michael. He's only tracking financial market liquidity, not liquidity of other things. And there are things such as loans and housing, particularly commercial real estate loans, where there's no bid, and the phones are silent. You can just plug them out because there's
Yeah.
no need to have a phone.
It's a super good point, Jack. We I think when we did our debrief of the last FOMC with Joseph, we talked specifically about the question that Chair Powell got asked about stress in the banking system through commercial real estate debt. I want to direct your attention as well, because we've talked about that quite a bit on this program. I want to talk about stress that's popping up actually in private markets as well. So there was a very interesting exclusive that PitchBook ran that sort of went under the radar, which was Tiger Global has opens full portfolio to individual bids in search of liquidity. So this is a little bit unique. Tiger obviously is a very well-known hedge fund run by Chase Coleman, one of the Tiger Cubs. They made a name for themselves for many years. They've got a public and a private market side of things, but really during this last sort of bull market mania, they really went big into specifically late stage private markets. They're very active in crypto, which is frankly where I'm most familiar with them. But there were all these stories about XYZ company raising $150 million at X valuation, and they would come in and take down the whole round and double the valuation, and many such stories like this. And and then once everything rolled over, they did a little bit of a cap raise. It wasn't as much as they ultimately would have liked. And now they're doing something that I think is pretty unique, actually, in just opening up their books and offering anything for sale, right? Including the prize hogs, so to speak. So this to me signals quite a bit of stress. And I think it is, this could be unique to Tiger because, to be honest, they were taking probably more risk than in retrospect it was wise to
They're
do.
also super heavily invested in China, and those stocks have suffered a lot.
Yeah, correct. Exactly. So they were operating in a very risky space, and what they were trying to do is sort of create an index of sorts. If you wanted exposure to these specific sectors of the market, they wanted to just be broad exposure for institutional investors. So I saw where they're sort of going with it, but now it's rolled over and is kind of going against them. The question that I think bears asking is this the tale of a large uh, hedge fund with a very healthy risk appetite, or is it the canary in the coal mine, so to speak, for private sector assets such as private equity or late stage venture? Because I would imagine they're not alone in feeling some of this pain.
Yeah, so Chase Coleman, a hedge fund manager. So that expertise and the expertise of that team, I presume something akin to I'm going to go, long JP Morgan, short Bank of America before earnings. Something that it's a pretty narrow skill set of long and short, and you got, a team who does options, maybe you trade currencies, macros, stuff like that. But you really, and this is key in investing, you don't want to go out of your lane. Like Charlie Munger and Warren Buffett, when they read an annual report about, oh, do I want to invest in this company or no? Let me learn a little bit about it. They said within 30 seconds they can just say, oh, this is too hard. Oh, this company, it's in Brazil. What does this business do? Like I don't really understand it. You got to really understand the business, and I'm sure that they are very good at going long, short, and other styles of investing. But they ventured, pun intended, into places where they did not have expertise. Maybe they didn't have the deal flow. Like, yeah, you're going to beat retail. Your well compensated portfolio managers are going to beat the retail investors that they're competing against in the publicly traded long short type arena, but they may not beat Chamath Palihapitiya and all the venture capitalists in Silicon Valley who know everyone and are in the thing. And so, I mean, I just heard and read stories, and I don't have any inside knowledge, just about Tiger Global trying to force their way into deals in the same way that, a tourist in an island town will try and get into a club by just like, I have all this money, like clear bouncer, take my money. It's like, you're not the smart money. You're not. This is not your home. And I think they invested in a lot of venture and they capital deals that now it's very hard to get out of. And venture capitalists who have a exemplary track record are in the exact same position. Liquidity in the venture capital market, so I read, has been quite poor over the past 6 months. It could be better now that the stock market's doing well. You had an IPO of Kava, the food thing that like doubled in the first day, and deal making activity in VC is somewhat correlated to IPOs because if IPO market is hot and the SPAC market's hot, then they can sell their positions to the public markets. And if it's frozen, then they are not going to be investing in early stage companies. But even though those venture capitalists who have the expertise, they're in the same position. But they know what they're doing, and they have a experience. Whereas Tiger Global, they just made the asset allocation decision, no alpha of we need to invest in venture capital because that thing has done really well. And you said an index. I think indexation is great. The S&P 500. I'm not going to be trading in and out of individual stocks and getting chopped to bits. And I think passive investing indexation is great, but you should be trying to generate alpha if you're doing the venture capital market. And by doing all the hot deals and chasing, oh my God, this company raised at 80 billion, I'll offer them 90 billion. Don't worry about it. I think that's just kind of a recipe for trouble. And perhaps that's what you're seeing.
Yeah, you bring up really good points, Jack. I do want to just give one caveat here, which is I'm pretty sure the public and private market investing at Tiger was actually divided in between. Chase Coleman, the founder, is what the more the public markets guy, and then there's a guy that leads their private investments. His name is Scott Schleifer. So I
A good distinction. Thanks.
Yeah. So just a flag there. But the point stands, right? It certainly they were doing things that, should they've been doing that? There's a reason, by the way. There's, Matt Levine has a great column of like people are worried about bond market liquidity. The reason being there are these ETFs that, sort of are these indexes of a whole bunch of different types of bonds. People have for a long time made the argument that each bond is different, right? It's every single one is underwriting a different bit of risk, a different period of time, at a different rate, and you can't necessarily presenting a wrapper that gives the illusion of liquidity without real liquidity in the underlying asset. And there's probably a little bit of that going on as well here. And maybe the high level idea seems very enticing of an index where you can just get broad exposure to late stage private markets. But the truth is, despite them being relatively advanced, these are still risky startup companies. And maybe the idea of an index is fundamentally at odds with the state of private market companies. It just can't necessarily be done super easily. But the last component to this is this might have been a tale of I want to not talk about any specific firm here, but definitely people got way over their skis in one of the frothiest bits of the market, which was late stage private. Another stress that you're also starting to see at another sort of storied private investor is Sequoia. So Sequoia's there were a couple things that I thought were pretty interesting. There was their heritage vehicle, which allowed investors to carry over from private markets, which, to your point, Jack, is really where Sequoia specialized and built many, generational businesses. And they sort of ventured into the more public side of things, which was maybe a sign that they were getting into unfamiliar territory or ground that they weren't as familiar with. And now they've obviously broken up, and there's going to be 3 different funds. There's going to be Sequoia based out of the US, and then there's going to be a China and an India fund as well. So sort of cracks forming across even some of the most blue chip private investors out there, I think.
Yeah, and the message is just stay in your lane. You can't be an expert in everything. You can't have alpha in anything. It's hard to have alpha in a tiny niche of the market. But if you try and have alpha in everything and get in every deal and do all sorts of trade every asset class, all sorts of strategies, you're likely going to be mediocre in all of them, if not bad.
Yeah. What? So you're saying just keep a healthy dose of humility, Jack? Stay in your lane? Come on. What is this? Give us some actionable advice here.
Well, if you have an edge. And if you're actually doing your homework and you're many hours a day, you're pouring through the filings, you're looking at doing all this research, you're doing back tests, you're doing all sorts of stuff, and you think you're doing it, better, more efficiently, better research than the other professionals, and you think you have an edge, then go for gold. I mean, there folks out sitting outside this room on the Blockworks crypto research team who, yeah, I think they do have a chance of beating the market when it comes to crypto. But like I wouldn't, I'm not going to get involved in any sort of very niche, micro cap coin that I'm gonna get my face ripped off. I'm
Yeah.
gonna stick to my knitting. Crypto is not my expertise. You know.
Yeah, I would completely agree there, Jack. All right, last story that I want to end on here with you is I want to actually take us across the pond here to our fellow citizens in the United Kingdom, where inflation has been an absolute beast of a problem. I've got some charts here to view. So to be totally clear, no matter where you sort of fall on the inflation is transitory sort of side of things, obviously it's still a problem over in the US, but it's far worse in the UK. And what we're seeing here, I've got a chart here of CPI inflation in the UK, the Euro area, and the US. And you can see in the US, it's obviously the lowest. The Euro area is higher, but UK, we're still printing eight some odd percent, right, of inflation, and that is a very large problem. So the yields of gilts have responded commensurately. And if you remember back, I believe it was November of 21, was it, that there was that strain in the gilt market, and we saw we had our mini budget plan, which saw the prime minister end up getting kicked out in one of the shortest reigns ever. And now it looks like yields are spiking right back up. This is the 2-year government bond yield, and it is really ripping because traders are betting that the Bank of England is going to hike rates to 6% this year. So, what do you make of all this, Jack? This is some turmoil, to say the least.
Well, on just the point about humility, they're very smart people, investors, people have been trading bonds for decades, who said in Europe, interest rates will remain at zero for the rest of our lifetime. And they drew a trend line and said, if anything, yields have to become even more negative in Europe. I mean, now looks like interest rates in the United Kingdom will be at 6%, not 1%, 2%, but 6%. So it just goes to say, even if you are smart and haven't done your homework, you can always be wrong, and you can even be disastrously wrong, as many were in this case. What was I going to say? So I don't really track the UK economy with a great amount of specifics, but I'll just say that chart which you flashed up of the year, that's year over year, I believe, headline inflation. So it includes the fact that the price of oil and natural gas has plummeted. First, it skyrocketed, and then it plummeted. It plummeted from very, very high levels to only, quote, high levels. But I just looked up the month over month core inflation rate, and in January, it was 1.2% month over month. February, 0.9%. 1.3%, 0.8%. Actually, I'm sorry, that was starting in February. So, excluding January, I mean, it's core inflation is running at an annualized rate month over month of more like 9, 10, 11%. I'm not calculating exactly, but that fall in that people who are watching the video saw is due to the year over year effects that the May CPI reading in the UK for 2023 is comparing it to May 2022 when the price of oil was like $130 or $120.
Mm-hmm.
So a lot of that is base effects, the year over year effect, and then the falling price of energy. So yeah, inflation in the UK is a big problem. I don't follow closely enough to know that the real source. I mean, maybe money printing had something to do with it, but we did a lot in the US as well, maybe more, I don't know. And inflation is a scourge, but has fallen somewhat, whereas in the UK it's vicious.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount.
Link is in the show notes. Sign up now. Thank you later.
Yeah, I'm in complete agreement with you there. And I think two things that just might be worth calling out is that despite this talk of the US losing its prominence on a global stage, et cetera, other countries still look to the United States in terms of policy. And that is especially prevalent, I would say, for the central banking community. And, I am a believer in this idea that everything trades off of the 10-year, the US 10-year. And what we're doing over here in the US, you know, we are sort of one of the few central banks, I would say, that can claim to be truly sovereign and in control of our own destiny. A lot of the other central banks have a little bit less wiggle room, including even very large one like the ECB and the Bank of England. So what I would just point out is that the US is sort of balancing, okay, there's sort of price stability versus risks of a recession. And even those two things are very difficult to keep in mind over here. But the European central banks have the additional challenge of, placing their own policy within the context of what the United States Federal Reserve is doing. So that's one additional layer of uh, of challenge for them. The other thing to point out is that part of the reason people have really been stumped over here in the United States about housing. So we've had mortgage rates scream up from sub 3% to 1.7%. And there were all these charts, right? You probably saw this is what the average American could afford at a 3% mortgage rate, and this is what they could afford at a 7% annual mortgage rate, and that implies something like a 40% dip in terms of housing, and we haven't even got close to that. It actually looks like smarter people than me, it looked like the bottom is forming in housing. The thing to note is that the vast majority of mortgages over in the United States are a fixed rate. In the UK, it is not so. It's much more common for the first five years or so to be fixed rate, and then you either need to refinance it or it just pops right over to a variable rate mortgage. So the impact could actually be much larger for the average person of rates and mortgages going up in the UK than it is in the United States.
Yeah, I mean, this is the ultimate example of not on my bingo card. I thought, yeah, high mortgage rates must slow the housing market down, and they did slow, origination activities because fewer people wanted to take out a mortgage or definitely refinance. Because why would you refinance a 3% loan to borrow at 7%?
Right.
But home building stocks are on a tear. That's another point Michael Howell made out. You have to respect the internals of the stock market. The two best performing sectors, or I guess subsectors, industries in this are semiconductors and home builders. Very cyclical stocks, indicating that we are emerging from a slowdown and that growth is going to be robust. And I typically I'm not a guy who says like the bond market is telling me this or the stock market is telling me that. But if you are one of those people, the stock market, you got to respect it. That's what the stock market is telling you. And yeah, I think home prices are going up, and if you look at like the sales price of new homes, that's where a lot of the activity is because people don't want to leave their homes because they have all these. They want to sit in their house just looking at their 3% mortgage and feeling good, so they don't want to relocate. So the stock of existing homes has fallen. So new homes have to fill in the gap, and that's why those home building stocks are doing so well. But yeah, it's a really surprising. And this is another thing about recession. It's like if you think that we're in a recession now, but you say, oh, an asterisk. Oh yeah, home building is strong, but that's only because of this reason. Oh yeah, well the labor market. Oh, but that's because of this reason. Because the BLS is doing something. It's like you really want to have a recession call with 12 asterisks? Like that's pretty close to not having a recession. By the way, I
Yeah.
still think that we could have a recession in 2024, and probably more likely than not. But I'm just saying, when the facts change, you have to change your mind. And obviously, I don't know what's coming in the future, but in September, October, recession was a mainstream call by economists who covered the U.S. I think Bloomberg literally has a tracker of the percentage of a recession, and it was at 99%. Okay. And so here we are, I don't know, 9, 10 months later, the economic data has been much, much better than those forecasts. And I think that's something you have to acknowledge. Obviously, anything can come in the future, and I'm not particularly optimistic, but I just think, for the sake of intellectual honesty, you can't just, double down and never admit that you were wrong. So
I totally hear you on that, Jack. Just kind of a high level question for you. Ignoring all the economic data that you and I parse out pretty regularly, does it feel like a recession to you right now?
Uh, I'd say no. I'd say no, and I think I it's not good to extrapolate from your lived experience, especially if you have a narrow experience such as myself, where you spend a lot of time in a city and you really, if you're a salesperson, you're okay. I'm in Florida now. I'm in Mississippi now. I'm in Alaska. You really do get to pound the pavement and see what the American economy is like. But I don't have that experience, so I would rely on more of a data driven view than my own sort of feeling. But yeah, I would say no.
Yeah. I think it's a little tough in this particular moment in time. You obviously extrapolate your own experience to some degree. I George Goncalves this week in our interview actually gave a pretty good overview of it for me, which is that there's a bit of a white collar recession
Oh
that's
yeah.
going on. And you are starting to see, I mean, frankly, these were headlines 6 or so months ago. It was every big company from Google to Facebook to Salesforce was cutting heads left, right, and center. That was after having done an enormous amount of hiring. I haven't gone back and checked, but I would guess their headcount is still well above where it was in 2019 before we were going into COVID. But you start to see that now. There were a couple banking headlines and things like that. So what it seems like is happening, because some of these bigger sectors, right, like housing and home builders, those have not been nearly as strained as you and I might have thought. Those are industries that employ a lot of people. Whereas, frankly, a lot of the knowledge worker, more white collar side of things that, you know, have less people, they're very richly paid, right? Often, maybe there's more of a recession in that part of the country, and that's why that maybe that's another reason why it's not appearing as much in terms of the overall unemployment number as well. So,
I think that's objectively true that a majority of the layoffs, as a percentage, not number, but a percentage, have been concentrated in technology and finance, typically higher paying jobs, typically a fewer number of jobs. I was surprised to learn, I think information technology hirings are only 4% of American jobs. So that is not, the average American worker is not a technology employee at all. That is not accurate.
yeah,
And I think government has been strong, so it's not a huge bull case when like the biggest employer growth in employment has been the government, but home building, manufacturing, many industries have been strong that employ far more people, service workers, and I think home building that has been robust, but it may stop a little bit, particularly on the multifamily side. But again, it takes so long for this to work through the system. I mean, like I did an interview with Dan McNamara, a credit investor who's very bearish on commercial real estate. He's basically like the Big Short, but for commercial real estate and office. So he's
mm,
short all these commercial mortgage-backed securities. And if you listen to that interview, you can get pretty scared, and it sounds like a disaster. And he think it is, but it's a really slow moving train. If it's a train wreck, it's a slow moving train wreck, and it could take 1 to 2 years for all this stuff to go through the pipeline. So folks getting all bared up, 9 months ago, they're a little too early. And in the investment game, being early is the same thing as being wrong.
yeah, I tend to agree with you there, Jack. It's the truth is it often is a little bit more nuanced than we all like to. It doesn't make for as good of media, right? It makes for better media to just stand up and say, this is absolutely happening. But oftentimes it takes a little bit longer and it's a little bit more nuanced in terms of, we're dealing with a very large, very complicated system in the form of the economy. Very
Yeah,
difficult to
yeah,
predict these
and,
things.
and I feel like companies doing dumb deals, that was something in 2021 and 2022. And I'll give you an example, like, you know, Netflix paying a gazillion dollars to Harry and Meghan, the Duke and Duchess of Sussex, to do like 12 episodes of a podcast or something. Like the they're cutting back. Those are the first things that get cut. Is like the 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 dumb sort of exposures. I don't know. I just saw that in the headline, and I was thinking. As a podcaster myself, I couldn't help but observe that. Like 12
Yeah.
episodes. You're not a podcaster. You do 12 episodes.
Yeah, I'm in complete agreement with you there,
Yeah.
Jack. So, and that those sorts of decisions, maybe we'll call it questionable ROI to say the least. I mean, you could do that across every spectrum of management and field of business or whatever over the course of the last, however many 10 years. I think one of the realities that's so if you trace it back to sort of this misalignment in between fiscal and monetary, then you say, well, monetary's been overactive because fiscal hasn't done necessarily enough, or they're not spending on the right type of thing. God knows they're spending a lot of money. Then what the decision has basically been to blow a bubble in assets. That has led to a bunch of capital misallocation that has not rewarded good risk management. And
Oh my
that is
god, you're so right.
it,
Yeah, yeah.
it
Oh yeah.
it just hasn't rewarded risk management. If you are a more cautious type of person, chances are over the last 10 years, you've been, you know, I think that sometimes unfairly gets construed as wanting to see the world burn. I think the more charitable way of describing it is people inherently want there to be consequences for actions. And
Yeah.
really, in the last 10 years, there haven't been.
And I'll give a perfect example of Uber. I'm a little biased as having recently read this book. I think it was called Super Pumped, which had a somewhat negative view. But
Mm,
as a company, you should be profitable. You should make enough money to pay your employees in excess at the bare minimum. Unless you're starting, if you're starting, or if you have a bad quarter, everyone has a bad year. It's cyclical stuff like that. But I mean, a company like Uber that was structurally unprofitable, and that more over a decade since its founding, it has. I don't think it ever turned a net income profit. EBITDA, of course, everything. But in terms of real non-fake numbers, I don't think it's ever made money. And I mean, that was just juiced to the gills by venture capital money. And it's saying, oh my God, if you can grow at 50%, that's perfect. We'll give you all the money. You can burn as much money. And it's just they've burned so much investor money. And I think even more bad consequently, investors can burn their money, whatever, it's fine. But it has negative consequences against the taxi companies that actually had to pay for costs that weren't internalized because Uber had this $60 billion war chest. And I mean, Silicon Valley, like, there's so many great technologies that have come out of Silicon Valley, but I'm just like, where are the great IPOs of the past 5 years? Whether not, I mean, let alone have they done something good for society, but I'm just talking about investor returns. I mean, their product. I mean, there's scene in Mad Men when a guy was like, I don't like their product, and yeah, just like you got to be putting out some better products. I feel like.
One of the challenges that I would say comes from technology is, ideally, if I was a government and I was trying to think about what is the best outcome for the majority of people, you would sort of want outcomes where the returns have a relatively even distribution. Not perfectly even, right? The people that take risk and manage others and harness social capital and real capital, and to generate returns, you'd want some outsized returns to accrue there. But generally, you wouldn't want it so that, to use hyperbole, a company that was spun up and managed by one person could accrue $1 trillion worth of value, right? You wouldn't think that would be, because so many people would not be served by that outcome. One of the challenges of technology is it does have this winner take all dynamic that, value can be created, but it accrues so unevenly. Like if you look at,
Mhm.
to the counterpoint to what you just mentioned would be, if you look at the S&P 500, the largest companies, they're like all tech companies now. And if you look at for every Uber that exists, there's a Facebook that was, now that thing just spits off cash. Same
Yeah.
thing with Apple, same thing with a lot of these companies that are unprofitable for a period of time. I think the thing that is more challenging, and this is only going to get worse in the era of crypto and AI, is these aren't job creators, Jack. Many of these, and I read the Mark Andreessen thing. I get it. I don't want to be a Luddite. I know that these technologies tend to create new jobs. I don't actually know. 20 years into the internet, I would actually argue that that's not true. I do not think that the internet has created more jobs than it has probably destroyed. And that doesn't have to be a bad thing, but we have to have an answer for it as a society. Otherwise, you're going to get a bunch of unemployed, disenfranchised people that are not happy. And that's not a good outcome either.
I'm with you. Yeah.
Yeah. All right, partner. I think that's all the time we have on that positive note,
Yeah.
Jack. I think
Yeah. Wow.
we can leave it. Actually, just to say one thing that is exciting. You often, I think the general, if I had to put my finger on the general sentiment and mood of people out there, not not as happy as people have been in the past, I would say. I don't think I'm reaching too far to say that. I do think there is a lot of opportunity, especially if you're a young person, in the workforce. Like, there is so much cool stuff going on, and I don't know. Despite sometimes I feel like the stuff that talk about on the show is skewed a little bit negative, I think there's so much to be optimistic and positive about at the same time. So I want to leave it.
Completely agree. I also say, I'm joking that I said I rebranded myself as an AI expert. I mean, there's so many people on Twitter who are just like, I'm an AI expert. Here's 10 things that you need to do so you don't get. And I feel like the narrative has gotten ahead of itself, but I feel like in investing, it actually hasn't. Like you aren't seeing deals you haven't seen an AI SPAC deal. You've actually seen an announced one. So I think the AI is moving past its early stages and it's moving into its middle phase. So I still think there are a few more innings left in that AI thing. And I'm not even saying that is a market call. It is not a view of the fundamentals on whether it can improve all this, and make things more efficient.
Yeah,
It could have some legs.
it'll have legs.
Yeah.
I actually, Jason, my other co-founder, he is a very early adopter of technology. Always on like the newest thing, has to get the newest. I'm the opposite of that.
I'm
I
with
would
you.
be
I'm the same way
fine
with you.
running a 5-year-old. I don't need any of this stuff. I'm a laggard on that adoption scale that everyone's seen. I use ChatGPT quite a bit. I actually use it in favor of Google oftentimes. If I'm other than like just, hey, what showtime is this or where is this thing, that I'll still Google. But if I'm like, how does this work? I will go to ChatGPT first now. And yeah, that's one small piece of data, like a slight anecdote. There are factual problems with it, but it produces more useful results for me than Google often. And now sometimes when I Google stuff, I'm like, it's just SEO BS. Yeah, this isn't even useful. And I don't feel like that with AI.
Yes, so I don't use ChatGPT, so I really am unqualified to talk to. But I've seen folks say that it really tells you what you want. Like if you asked why is On the Margin a better podcast than Forward Guidance, it would say because of blah 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 blah. It would give all these valid reasons. If you ask the reverse question, it would give you all these reasons, and if you say why are Republicans better than Democrats? Why are Democrats better than Republicans? It will tell you the answer that they want you to hear. And that raises ethical questions that are beyond the scope of our conversation for sure. But should we leave it there?
Yeah, let's leave it there. Jack, this has been a fun one, my friend. Mark, we missed you this week. See you soon,
Yeah.
buddy.
Thanks, Mike. And looking forward to next time you're on, Mark.